I think we are winding up here. And so usual format for this thing. So I will run through the news this week, and then I will bring in our guest for this week, which is Craig Martin, who's the executive chairman at Diamond Capital, which is the company that manages Vietnam Holding. And Vietnam's quite an interesting story in the whole thing of what's going on with COVID, and probably quite an exciting long-term investment opportunity. So it should be an interesting session anyway. We'll give you a chance to answer questions at the end. What I'll do is this usual thing. If you are logged in through Ring Central itself, you'll be able to send me a message through the chat and ask a question that way. Or there's a facility where you can raise your hand. Otherwise, if you just email me at jc@martin&co, then I will be able to just feed your questions through that way. So without further ado, being 11:02, let's kick off. So as last time, we'll just keep it sort of to a few sort of top themes really. First one of those is unsubsidized renewables, and there's a reason for that. It's because I think the next energy's just done. Thought we'd talk a bit about Brunner, because Louisa McDonald's just left. Aurora, because it's got an unusual management fee, and also Jig royalty, which is just a Scrip dividend. So, first thing, unsubsidized renewables. All of these charts are taken from the QuotedData's website, unless unless indicated otherwise. As you can see there, the premiums on these things have come bouncing back largely. There's nothing there that's on a discount. Though they're not as high as they were before the whole COVID thing started. And some of these, like Next Energy now is down to like 3%, which is relatively looking quite cheap. And obviously the big thing and the main attraction for these things is the yields. And you can see some of them are really quite whopping. So Next Energy 6.7, Gresham House, 6.7. And those are the main attractions. So anything that threatens the yield is obviously a big influence on the stocks. So what has been running as a major thing now for probably about a year is that we've had this steady drip falling power prices, and this doesn't affect the companies straight away. Most of them have sold their power forward, so that means that they've locked in prices much higher than actually you see in the existing market. But what we have seen is a steady decline in power prices, especially since the end of 2018. And this chart from Ofgem only runs up to the beginning of this year. So you can see at the beginning of the year, the electricity price there was about, I think it's about 36, something like that. And the gas price, 28, more or less. Today, those prices are much, much lower. Power prices down to 29, and the gas price down to 12.5. A lot of that is down to COVID-19 and the decline in demand for power. So generation keeps pumping stuff out, and we're not using it, so the prices are falling. That is obviously a temporary thing, and there should be a rebound, but there's just general ongoing thing with long-term thing with falling power prices. And of course that led to the scare that we've maybe talked about before, which is the Bloomberg new energy forecast that said power prices are going to go much, much lower as we bring on more and more renewables. The counter to that was, well, why would anybody develop their renewables if power prices are falling and they can't make the returns? And actually, the government seems to have cottoned on to this. So they have a consultation going on proposals to reopen the subsidies for onshore wind and solar. And this is it. for the auction round 4, AR4, which would happen, I think, a year after next. The trouble with bringing onshore wind and solar into the mix will be that it will crowd out everything else, because it's so much cheaper to generate electricity that way than it is from offshore wind or anything else. So what they're proposing to do is have a pot of money available to subsidise new onshore wind and solar, as you see there, pot 1, and then a separate pot with everything else in it. Offshore wind, geothermal, floating offshore wind, which is a new idea, which lets you take a largely the wind resource in deeper water. So all these things, quite exciting stuff. And we have seen a lot of investment going into these areas. So in the last auction round, AR3, we did see, I think it's 6 gigawatts of new offshore wind approved. And that's coming in at 40 megawatts, which you can see there is up above the line, even as it was at the beginning of the year, and well above where we are now. And that's what's going to make the difference. If the government comes in and tops up the returns that these companies can make, then it is worth them investing. And the way the CFD works, it sort of gives you this sort of floor in the power prices you receive. It doesn't then matter so much what happens in the day-to-day power prices, and they can still keep investing and still keep paying the money and still keep paying the dividends. So from that point of view, it could be quite good news. Just before we go on, but the problem is that if you've invested in this pretty brief window of new unsubsidized solar plants, they won't qualify for these new subsidies. So you're going to be completely exposed to these falling power prices. And what Next Energy has done this week is announced it's sold 2 of its subsidy-free power projects, 115 megawatts worth. They're getting 11.5 million for it. They say that's going to be a profitable transaction for them. So they're still funding the development of these and selling them on. They're still going to earn returns in line with their 7 to 9% a year targets. But it does mean, I think, that the unsubsidized stuff is probably getting even less attractive, because we kind of wait for to see what happens now. So we might kind of move sort of hiatus in the market for a while. Other stories we've seen this week, UK Wind announced £320 million deal to fund a thing called South Kyle, which is a new onshore wind thing that won't be finished though until 2023. So it might be able to bid for these subsidies. So that will make sense from that point of view. Renewable Infrastructure Group is doing more in Europe. And they just said this morning that they've actually closed their deal for offshore wind in Germany. It's a thing called Merkur, which is a huge great plant there. So we shall see what happens. Brunner now, I thought that was worth just mentioning. Obviously, Lucy's been around for a while. There's something I quite liked. She's been replaced by this guy, Matthew Tillett, who's been at Allianz for a while. And is said to have been working with her for a while. They always say that, but I think it's probably true. They say it's down to the kind of reorganisation of the way the team works. So we'll see what impact that has on the way the fund is run. Hopefully not too much, although if we look at the return to the situation here. So it's a decent sized fund still, 300 million quid, trading at a reasonably tight discount, that it could be tighter. And a reasonably attractive dividend yield. And the yield's quite important. But the returns have really not been that great. So over 5 years, it's 11th out of 16 funds here. And then over 3 and 1, it's 10th out of 16. This isn't wonderful. And normally that would mean I wouldn't be drawing any attention to it. But Brunner's been hugely hamstrung by very expensive debt that it's had over the years. And this has cost it quite dearly in its sort of 3 and 5 year numbers. And I'm hoping that this is going to fall out, and then the revamp of the way that's going to get managed is going to improve things. So it could be better. This was the cause of all of this. Truly the worst thing that ever happened to the investment trust sector, I think. Back in 1980, the very end of 1987. I'm not sure who actually dreamt this up, but first debenture finance, you can see that 80 million quid's worth of 11.125% debenture stock 2018. So very long dated, very, very expensive. It was even worse than this, though, if you look at the clause in the middle of the agreement. So the interest rates started off expensive but manageable, and then grew every year until 1998, by which time they were completely outrageous. And this destroyed the returns of all of these companies. Brunner, what was Charter Europeans, now was disappeared, merchants, and climate smaller companies. Yeah, it sort of finished them off, really. So now that we've got through this phase, hopefully these things are going to be much improved. And I think that's probably true of merchants too. And it's a cautionary tale never to do this again. This is the story. It cost them money, even in 2018, when we were almost at the end of this thing. It cost them money to get rid of another one, because it wasn't the only one they did. In 1993, they did it all again. 15 million quid at 9.3% a year. And the minute you see somebody looking at long-term debt, I always question it. Even this new tranche of debt that they took out at the time to replace it, 2.84, you might be able to do that cheaper now. I'm thinking that now, with rates as low as they are today, it might be a good idea to lock those in, because something else I've been talking about recently is that we may actually be seeing inflation in the future. That's something we might address in a couple of weeks' time, if we can find somebody to come and talk to us about it. Aurora next. It's one of these companies that thought it would be a brilliant idea not to charge investors a base management fee, but to take all of their managers' remuneration on a performance fee. And you can see, so under James Barstow, it had brilliant periods, it had poor periods. It was pretty unloved. When Phoenix came and took it over, the thing moved to trading asset value, and it's done pretty well, reasonably well since. It's been issuing stock, expanding, great. But the first performance period that they had under their management, they actually lagged the index. Not too clever. Sorry, just to be clear, we're not looking at, what we're looking at there is the NAV and the share price. The NAV is the green line, not the return. So it's still, they underperformed in 2016. It's had a much better year in 2019, enough to earn them a fee for the first time, 1.3 million quid. But even now, they haven't actually got their hands on that. They have to take that in shares, and they don't get those for 3 years. And if they underperform, then they have to hand that money back again as a clawback mechanism. So of course, with what's going on with COVID, it might not be anything again now. So yeah, it's a noble idea, but a daft idea, I think, to do this sort of pure performance fee thing, because they do deserve some credit for what they're doing. Having said that, we should look at the returns. The returns aren't amazing. And largely that's been dragged down by the recent performance, and that's because you look at the big positions. Largest one, Sports Direct; second one, EasyJet, and you also got Ryanair in there. A lot of managers have been caught up because I suppose they didn't know how, if the economy was going to slow down, how it was going to slow down, and what's happened with COVID-19 has taken a lot of people completely by surprise. And they have been massively caught out. It's hard to see, though, that the money that they're losing on this, it's not going to be an easy thing to get that back again. So there we go. Lastly, go down here. My screen is now frozen, which is great. We'll wait for the program to run. I'll keep talking. So lastly, I just thought I wanted to mention the Duke royalty. There we go, Scrip dividend, which I've illustrated there with smoke and mirrors. So what they announced this week was, given what's going on with their borrowers, the people they've lent the money to, they've decided to be lenient with them, and they are rolling up some of the interest and doing debt for equity swaps and that sort of thing. But that means they haven't got as much cash available. So rather than paying out the cash dividend, they're going to pay out a scrip dividend instead, which sounds great. The shares have gone up from 19p to 24p in the back of it. But actually, as I tried to explain yesterday, and I still don't think it really understood, it achieves this absolutely pointless exercise. If you just get given more shares in proportion to your holding, you would just end up with shares that are worth less and exactly the same. Well, the underlying NAV goes down. But you end up with exactly the same position as where you started, except for the cost of actually doing the exercise. But for whatever reason, that seems to have deluded people, and the share price has gone up. So yeah, there we go. Anyway, enough of that. Enough of the news. Let's now turn to. Well, I should actually, before I go, one thing. Just while we were getting going, you may not have seen Mark Barnett's just been kicked out of Invesco. So that's it's a shame, really. I always quite like Mark, but given what happened to his portfolios, it's maybe not surprising. So that we something we'll follow up with the story later. But I think it's actually on the QuotedData website now. Anyway, let's now to the main event of the day. Let's go and talk to Craig. So let's maybe see if I can unmute him. There we are. Good morning, Craig. Well, I suppose it's not good morning for you, is it? It's good evening.
It's good evening, yes, but a very good morning to you, James.
Thank you. So you're based in Vietnam, aren't you?
Split my time between Vietnam and Singapore. Because of COVID, I'm firmly locked down in Singapore at the moment. My colleagues are all happily enjoying life in back to normal Vietnam, but I'm in Singapore.
Fair enough. Cool. So I just could have kept it simple on here. Just if we can sort of run through the basics really about Vietnam Holding, tell us a bit more about it.
Sure.
I suppose the first question is what's the attraction of Vietnam in the first place? Over to you.
Yeah, sure. So I'm managing with Dynam Capital. We're managing Vietnam Holdings, the London-listed closed-end fund. Our portfolio is a very concentrated portfolio. It's an active portfolio, only of Vietnamese equities. We focus on the consumer, industrialization, and urbanization themes. And why? Well, because the Vietnam macro story is strong and very supportive of those areas. So for your why invest in Vietnam, it's a high spot of growth within Asia. Last year it was the highest growth market in Asia. Came into 2020, very strong macro position. And this year it's still growing despite COVID. It's going to have a positive GDP growth. And so once again, it'll be the envy of Southeast Asia. And it's attracting a lot of interest as a kind of China plus one strategy. But more importantly, and for us, you've got hardworking, determined population of close to 100 million people with per capita GDPs that kind of suggest we're at an inflection point in consumerism. So it's a really exciting place to be. And obviously we can talk a little bit about COVID, but that aside, Vietnam continues to be a very strong investment opportunity and a good diversification story.
There's still quite a long way to catch up before Vietnam catches up even with China, isn't there?
In terms of what? How?
Yeah.
Yes, no, absolutely. No, so Vietnam's demographics and its consumer growth story are probably 5-6 years behind China. When China got to $3,000 per capita GDP, it doubled again in another 6 years. So Vietnam is just at that inflection point of $3,000. It's trebled in less than 15 years. It's probably double again in half that rate. So exponential. So yes, it's 5-6 years at least behind China, but we're already seeing good levels of consumerism, and that's also reflected in the urbanization story that we follow, people looking at real estate opportunities, and industrialization, building on almost 3 decades of high levels of GDP growth and lots of foreign direct investment.
I think the amazing thing that I experienced the last couple of years is just how much the government finances have improved, and the balance of exports and imports has changed, and the currency strengthened, and it's just a much stronger economy than it was even 5 years ago.
Yeah, absolutely, and that's a very key point. So Vietnam ended last year, came into 2020, record levels of foreign reserves on the back of record levels of foreign direct investment, accelerated by Trump's kind of tweets and tirade against China, people looking to relocate manufacturing and supply chain to Vietnam. Strong surplus from its trade. It's a very wide exporter of goods, many types of goods all around the world, and ended last year with a massive trade surplus, record trade surplus. The Vietnamese are also very hardworking wherever they end up. And you have a large population of Vietnamese in America and Europe and Australia and other places. And they send in $16 to $18 billion a year in remittances. So all of those 3 stars were aligned last year, has ended the year in a very strong macro position. And that's helped insulate and buffer against the coronavirus and the impact that Vietnam's seen. But actually, as people are probably aware, Vietnam has handled the COVID situation remarkably well, and that buffering is going to help it continue to grow this year.
And to what extent is the government still pulling all the levers in the economy? How much has it moved away from that central command and control structure?
Well, look, I think the central command and control structure has been a great win for Vietnam. I mean, partly how it's handled the coronavirus situation so remarkably has been because of some of those levers from its kind of societal makeup. Just to put that in perspective, a population of almost 100 million people, 0 reported deaths from coronavirus. In 30 days, the last 30 days, no community-to-community infection. And Vietnam was the first country in Southeast Asia to get back to work. So a lot of that is to do with the population who have a strong social contract. It is to do with the kind of state apparatus that can get messages across very quickly. It can enforce control. It can isolate people, test people. It can also then look to, on the flip side of that, how to re-engage the economy as it's getting back to work. And so they're looking to put stimulus and investment of maybe up to $30 billion over the next 12 to 18 months into domestic economy. So even if we saw a little bit of FDI drop, which we haven't actually seen, FDI is still quite strong into Vietnam. A lot of people are looking more now at this China plus one. The government is using the tools of domestic investment. And a lot of that's going to be looking at infrastructure, which of course has a multiplier effect. Mm-hmm. So the kind of dual system of a kind of a socialist thinking DNA and a market economy in terms of economic participation actually is working for Vietnam. In some ways, it's the envy of much of the world at the moment.
Yeah, cool. Okay. So can you tell us a bit more about Vietnam Holding then, and sort of the history of it and how it came to be, and the management team and that sort of stuff?
Yeah, so look, we're a small team, 12, 13 people. All we do is manage Vietnam Holding. So we're obsessed and focused entirely on the success of Vietnam Holding, which, as I say, is a London-listed investment trust. From its very, very early days of inception, we have put ESG at the heart of what we do. The fund has been a signatory of UNPRI, the United Nations, the Principles for Responsible Investing, for over a decade. And we build ESG into our thinking at every stage of what we do. Now, for us, we can do that because we're on the ground. And so we've got a very strong, authentic engagement with the portfolio companies. So reason we're concentrated in our portfolio, 20 to 25 positions, is that we can have regular conversations with our companies. We can see how they're doing, how they're handling coronavirus. On the ESG, what's very interesting to us is the G, the governance. Obviously, the E, very well understood in terms of reduced carbon footprint. The S is also very interesting. How are companies dealing with their staff? how they're dealing with their suppliers, how they're dealing with their stakeholders, kind of like 3 S's within ESG. And by being on the ground and being actively engaged with these companies, we can monitor that. We can get a sense of, is our conviction level right? You know, should we be putting more behind these companies? Or sometimes it's, well, hang on a minute, there's an issue there. So ESG is there not just to feel good. ESG is there because we think it drives performance and value in the longer term. And if our portfolio companies do well on that dimension, we expect over time they'll be better rated, and our investors in our fund will do better as a result. So simple. We don't try to do anything too complex. We're very nimble across the asset size, but only focused on equities in Vietnam, ideally businesses that we can really understand and build up conviction over time. So very simple story. Vietnam's got a great macro. We think the equity story is a good story in Vietnam. And if you're patient, we think over the next 3 to 5 years, that patience will be rewarded as, you know, Vietnam's going to come out of coronavirus, you know, different. Everyone's going to see changes in their business models and their economic performance. But Vietnam, golly, you know, what it's done in terms of taking a couple of rounds of coronavirus head on is quite remarkable. And I think the people have done a fantastic job collectively in managing this.
Right. And who's actually in the management team? Who's actually running the money and picking the stocks?
So we're a small team. So myself, my business partner, Tin, we're the 2 managing directors of the business. I've been involved in investing in Vietnam and emerging markets of Southeast Asia for over 25 years. Tin has been asset managing and running the portfolio for 7-8 years. Prior to that was a consultant with a large firm, so has a very authentic engagement. So we're a close-knit team. We're very collegiate. We own the business. We make the decisions, and we implement the strategy. So we're looking at simple businesses, easy to understand, that we hope can compound over a good horizon, and as I say, that we can get engaged with to deliver our ESG mandate. So we're all over the portfolio, right, regularly in touch with our companies, and just trying to make sensible decisions and do things simply. There's no leverage in the fund. You mentioned earlier one of the funds today where that had caused the fund to come unstuck. There's no gearing, simple structures, simple businesses, get to know them well, build up our conviction, and really engage with our portfolio companies.
Oh, okay. So let's see, there's kind of a few questions in, so let's try and deal with some of those. First of all, I suppose this is a bit, it's almost Trump-like. Can we really trust the stats coming out of Vietnam on COVID?
In simple answer, yes. Is there a margin of error on 0 deaths? Maybe. If there is a margin of error, it's not a massive scale factor. In truth, it's hard to say, but people have gone through the funeral parlors and there's been no increase in obvious deaths. There's no bodies kind of stacked up in refrigerated lorries that there perhaps are in New York City and other places. So deaths low. Why? Well, because of quick action, effective control.
Oh, okay. How long do you think it will be before the economy normalizes? I suppose that's a slightly open-ended question, but.
Well, look, it is, but to put it in context, Vietnam was the first country in Southeast Asia to come out of lockdown. So at the end of April, people were back at work. So it's normalizing pretty quickly. The traffic's starting to build up. People are shopping again. People are wearing masks. Vietnam was a very early adopter of wearing masks, even when it was very unfashionable in the rest of the world to do so. And again, maybe that's why their infection rates and death rates are low. So people are getting back to work, dealing with the new normalities of a COVID existence so quickly. Could it be a V-shaped recovery? Yes, in Vietnam it could. It's able to move quickly. Not going to be isolated clearly from what happens in the rest of the world, but yeah. Vietnam getting back to normal, it's pretty much there.
I suppose, the sorts of things that it's exporting, they range from, I suppose, some of the things. Do they make PPE and that sort of thing?
Yeah, the big exporter of PPE, big exporter of masks. Now it's an exporter of test kits. approved by WHO to France and the European Union. It's an export. It can export ventilators if needed, although it doesn't look as if we need those at the moment. But masks, everyone's going to need them. UK, having laughed at Asian kids on buses and trains back in January, well, everyone's going to be wearing masks on buses and trains in the UK. And some of those will be exported from Vietnam. So it's a big exporter of those, big exporter of high-tech products as well, big exporter of Galaxy tablets and phones, and maybe in the future Apple products, a bit like these AirPods as well. So across the spectrum, as well as, you know, a big exporter of rice, a big exporter of rubber and commodities. But over the last 3 decades, it's really moved up the value chain. Vietnam's earned a lot of money from the FDI and from that export story, but it's also started to kind of invest in the infrastructure, the business linkages from that broad range of export products.
Yeah, cool. Have any companies been affected materially by what's been going on? I suppose that the tourism must be an area that is quite hit by bad.
Yeah, tourism's been hit very hard. We don't have any exposure in our portfolio to tourism, but you know, the broader economy, airlines have been hit hard, hotels have been hit very hard. I think some sectors have been resilient. We've seen some domestic supply businesses being resilient. We've seen telecommunications be very robust. One of our largest positions is a broadband. A part of its business is broadband internet and pay TV. That's seen a strong demand during the lockdown period that ended 3 or 4 weeks ago. Some sectors will suffer more. So the garment industry, Vietnam's not doing anything wrong. Its model is intact. It's a low labor cost. It's good efficiencies, hardworking people. But simply as the US and Europe see softening in demand and shops shut and shops going bust, Forever 21 going into Forever Chapter 11 and all these kind of things, we'll see orders get cancelled in Vietnam. So the garment sector we're less keen on. Fortuitously, we were reducing our exposure to that sector. And as you say, tourism has been hit hard and the airports have been hit hard. But a lot of the domestic linkage is strong. We've seen good growth in one of our businesses is in cold chain logistics, supplying chilled products and meats to supermarkets and modern trade. Their EBITDA has grown 100% year on year, looking at Q1. So some of these businesses have seen very strong growth.
Oh, okay. Given that you actually have a sort of quite a big trade balance with the US now, do you think you might end up coming into some kind of trade dispute with the Trump administration?
Well, it's a good question. Who knows what's on Trump's next tweet tirade? But what we saw last year was, as you say, a big increase in exports, up almost 50% to the US, really stealing market share from China on production and export of products. Trump and America actually needs Vietnam. They're very friendly, good terms with Vietnam. Vietnam's a good friend to have in a sea of uncertainty, the sea both metaphorical as well as physical. So in the East Asian Sea, or the South China Sea as the Chinese refer to it, it would be great for America to have some stronger naval presence. And actually Vietnam has very strong natural harbors that the Americans have used before, of course, in the not too distant past. And so I think America wants to keep a strong position and very good terms of trade with Vietnam. But let's see, there've always been some quotas from the US to Vietnam on products that Vietnam's been very successful in, including seafood and aquaculture. But we don't anticipate there being anything direct that's going to destabilize Vietnam. I think when China and the US, if they come to a further war of words, let's hope it is just that, as a result of finger pointing over COVID, I think it will further accelerate this China plus one strategy, of which Vietnam should be a very strong recipient. Not only Vietnam, of course, there'll be other places, Indonesia and other markets. But Vietnam has good linkages. It's back to work earlier than some of those other Asian countries. The Philippines, Indonesia have still got a lot of issues. So it can be a legitimate source of manufacturing and maybe an American-friendly source of manufacturing.
Can you just explain what China plus one is? So I'll just cover that. Yeah.
Yeah, sorry, jargon's hard, isn't it? So China plus one in the sense that, you know, China, the world's manufacturer. And then last year we saw a little bit of, well, hang on a minute, if they're aggressive anti-dumping and there are tariff disputes, China becomes a little bit more expensive. So if you're a global manufacturer, if you're Apple or if you're a Samsung, and you're having product made and so reliant on China, makes sense to have multiple destinations. So we start to see last year, it started to be evident last year that not only was Vietnam's FDI at record, foreign direct investment at record levels already last year on a strong increasing trend, but there were specific people looking to, well, let's move a factory from China to Vietnam, or let's move a factory that's in Korea to Vietnam, such that we're not so exposed in our supply chain. That was a story of last year around trade. That's starting to get warmed up again, partly because of the realities of COVID, but partly also because anticipation of further battles between the US and China on the trade dimension. So China plus one means let's put some manufacturing in Vietnam, let's put some manufacturing in India, let's put some manufacturing in Indonesia, and have a more diversified trade strategy.
Okay, that would make sense. There's one other question I can kind of be saving to the end because there doesn't seem to be anything else. But what's the I suppose the question basically says, why should I go for VNH? What's the difference between you and the other Vietnam funds?
I think for Vietnam Holdings, we're focused across the size. We're nimble across small cap, mid cap, large cap in Vietnam, and that means that we can look at the kind of the gems that will grow, become mid caps and large caps in the future. Because of we're right sized to the market and our single client focus, we're able to unearth these opportunities. So perhaps for some of the larger funds, it doesn't make sense for them to look at, you know, putting a $10 million investment into a growth business in cold chain logistics, but we get excited by that. We think it's a great sector. We found a really good business. We're the only investor in it. And so in many cases, we're the first investor in some of these companies as they're listing or even when they're listed. So we can look at something that's perhaps below the radar of perhaps the larger funds. And Dynam, as the manager to Vietnam Holding, they say all we do is manage Vietnam Holding. So we live, breathe it, we're invested in it. Our success is directly linked into the success of the investors in Vietnam Holding. So
well, actually,
it gives us a strong focus.
Segueing straight into the next question, actually, which is, does Dynam plan to launch any other funds?
Look, not at the moment. If there are adjacent strategies looking at growth in the equity space where we can add value, then yeah, we'd certainly would take those conversations. But our focus is really just delivering that engagement, genuine, authentic ESG, not just window dressing, and picking good businesses that in the next 2 to 5 years can double in value and show rewards to our patient investors.
Actually, I suppose this question is for you too. So why do you have an open-ended fund? You don't, do you?
No. So Vietnam Holdings is a closed-ended fund. So we just manage the one fund.
Presumably that wouldn't really work, given that you're taking big stakes in things that aren't necessarily that liquid.
Yeah, look, I think the advantage of being a closed-end fund is exactly that. You're absolutely right, James, is that we can be in businesses that perhaps have lower liquidity at times, and we can hold them for the long term without having to try and cut a position to meet a redemption. So we don't have that pressure, and we can be not just clustered around perhaps the crowded trades and the larger caps in the index stocks, but we can really be a little bit off-piste, looking at good businesses that have 20-30% kind of compounding growth potential, and that's part of the benefit of being a closed-end fund structure.
I've muted myself and I'm talking. So I think we've exhausted the list of questions. So thanks very much, Craig. And we'll be writing a note on you quite soon, so people will
Okay, great.
Update.
It's been a pleasure. Thank you.
Thank you again. Cheers. Bye-bye.
My pleasure. Take care.